Right. I hope you all can hear me. Good afternoon, and thank you for taking the time to hear what we're going to say. This is actually the second time today I'm giving this presentation. The first time this morning was in front of a live audience, and that's very, very different because you can read the crowd, you can interact in the conversation. Here I am sitting alone in my office speaking to my computer screen, which is a totally different dynamic altogether. I encourage you to ask questions via the Q&A, and I will get to them in due course. Okay, the purpose of the call, it's being recorded, but it's about between 40 minutes and an hour. I'll stop it at 1 hour. I want to review the markets, what's happened in the markets. I want to share some thoughts with you about how we think about some of the challenges we're facing and how that affects our portfolio positioning. Okay, so let's dive right in. So nothing happened. There we go. So while I have your attention, I'll start with a summary, and then we're going to drill down into each one of these topics and discuss them in a little bit more detail. So 2024 so far is off to a very strong start on the equity market. I'll show you. NVIDIA is a big contributor, so we're going to talk about that aspect. The US economy is still very resilient, but slowing in certain sectors. Nominal growth last year was more substantial and inflation was more substantial. So we had about 2.5% net real growth last year. And this year it's lower nominal growth, lower inflation, and around 2.5% net real growth again. But still certain parts of the economy are showing some pain, but nothing terrible, okay? Nominal growth is more for the newspapers, so to speak, and real economic growth is more for the economists. We've had a little bit of interest rate volatility. Interest rates went up. When I talk about interest rates, I'm talking about the 10-year and not the Fed funds, which is what you read about in the newspaper, that the Fed increased rates or decreased rates. I'm talking about the 10-year, which is set by the market. If the 10-year rate goes up, then the price of bonds goes down. So we had a little bit of an increase in interest rates, nothing like 2022. And we started the year at 3.8. It peaked at 4.7 and it's currently around about 4.4. So a little bit of pain on the bond market, certainly not near the performance of the equity market. Inflation is trending down, much slower than it did in 2023. The beginning of the year, headline inflation was 3.2. It's now around about 2.6, 2.7, and this is where we expect it to finish the year. We've actually had 2 months this year where we had a slight uptick in inflation, which gave the market some jitters. And it just shows that inflation is much stickier. It's much harder to get it from 3 to 2 than it was from 8 down to 3. And we'll talk about why that is. So far, the recession has been avoided. When we went into this high interest rate period of time, the consensus view was that there was going to be an economic slowdown and perhaps a recession. Recession wasn't a foregone conclusion, but there was certainly some negativity. That hasn't happened yet. There are signs that it might still happen. We're not out of the woods yet. Goldman Sachs put a probability of a recession at about 30%, which is actually up from their previous estimate, but still reasonably low. Geopolitical risk is increased. I don't have to explain that to you unless you've been living under a rock. Geopolitical risk is definitely on the rise. Okay. So next slide. This is the main indices. This is what's going to be affecting your portfolio. S&P 500 year to date plus 15%, annualized, that's 30%. That's a very, very strong start to the year. Interestingly, NVIDIA, one stock, is about 5.5% of that 15%. Okay, so you got one stock giving you 5.5% and another 499 giving you the remaining 10% about. So very, very strong contribution by NVIDIA, and certainly that has given the market some positive momentum. Looking back over the last 36 months, 3 years, we got roughly 11% a year, which is pretty much what we've got used to from the S&P since 2008. And it includes 2022, which was a negative year. So again, showing the importance of staying invested in equities, letting them recover after the bad year. NASDAQ is not what people think about NASDAQ around the dot-com bubble. It's a lot more stable than that. And it also produced positive returns. Again, NVIDIA was a big component to that. MSCI World Equities at plus 11. You can see the rest of the world is not nearly contributing as much as America, especially if you look at the last 3 years, plus 18% versus plus 33. That's a very substantial difference. Tel Aviv 125 equity index in shekels, 3.39 plus. Not bad considering what's happening around us here in Israel. Look at the 3-year number. That kind of makes a bit more sense given the period of political reform and then the war. Still a positive number, but a disappointing positive number. China, positive this year at 4.8, not very different from Israel, surprisingly, but a complete disaster on a 3-year view at minus 44. Global bond, the main index that we look at is the Bloomberg Global Aggregate Bond Index in dollars, minus 3, reflecting that rising interest rates that I talked about in my snapshot slide. And if you look at the last 3 years, we're still showing a lot of pain from 2022. 2022 interest rates went up 5% about. This particular index was down about 16%. So over time, we've recovered our coupon, but still, it's a very poor result for bond investors over the last 3 years. Treasury bonds, government bonds, this is a particular ETF, not one index. So again, showing the rising interest rates, minus 1.5%, minus 13% on a 3-year view. Israeli corporate bonds have done slightly better, interestingly enough, both on the 1-year view and the 3-year view. Israeli interest rates came down a little bit in Israel, but still it's encouraging that there's a positive number there. Okay, now let's have a look at the equity market in a little bit more detail. All right, so why is the stock market doing so well? Typically, election years are positive. We've got used to that. Going back many, many years. There's a lot of strong earnings coming through, especially from the mega caps. When I say mega caps, I mean the big names that you're all using on your day-to-day basis. Apple, Google, Facebook called Meta. Some of you might drive a Tesla. There's those companies are doing extremely well. They're making lots of money, and they're leading the market. There's the AI theme, which is still being developed. I don't believe we're at bubble territory yet in the AI theme. NVIDIA is the clear winner from the AI story, but it's pushing up all the mega caps. Okay. If the mega cap expansion continues, then there could easily be plenty of upside left in the equity market. If for some reason the mega caps contract, then one of two things is going to happen. The rest of the stock market can come up a little bit, or everything will go down together. I'll show you the valuation argument in a second. And within the equity market, there are still sectors which are interesting. One sector which we're doing a lot of research on right now is the defense sector, on the basis that governments are going to be ramping up their military spending, hopefully just for Cold War purposes. But it's not an easy sector to access cleanly if you want the pure weapon manufacturers, because there's a lot of government-owned companies, and we don't want things like Boeing and Airbus in there, which a lot of the indices have. Reasons for caution. Obviously, the election with Biden's condition, there's a lot of election uncertainty hanging over us. There is an element of economic slowdown. I did pointed that out. We have higher valuations. There's no pretending the stock market is on the expensive side. And services sector inflation is still very high and very sticky, and it's very hard to bring down that services inflation. I'll show you in a minute. And of course, geopolitical risks, Middle East, Ukraine, Taiwan, anything can happen there. A small incident can become a big incident very, very quickly, and that would definitely affect the equity market. I see there's a couple of questions already. I'm going to address them later on in the presentation. Okay, let's talk about valuations. Now, I'm an accountant, and I can, by profession, I can tell you that there's no perfect measure of valuation. The one measure which we use is price to earnings, which is how many years of earnings are reflected in the price. It's by far not a perfect measure of valuation. But if you look at it consistently over time, it'll give you some idea of where the market is on a valuation point of view. It's not a great strategy to trade based on price earnings multiples. There are variations of this multiple, but again, it's simplified. Don't take it as face value that it's all that it is the be all and end all. It's not. It's just one measure. So this graph I like because it shows the different valuation of the mega caps, or the 10 largest companies, and the other 490 companies in the S&P. The 490 companies together have a PE of 18, which is only slightly higher than a longer term average. Not terrible at all, not too frothy. But the big companies, the 10 largest companies, those are definitely looking frothy at 30 times earnings. What bothers me is not so much the pure number of 30 times. What bothers me is the size of the profit that's required to maintain that multiple. Okay, just for example's sake, for Microsoft to maintain its share price, every year it has to add to its profit the entire profit of Coca-Cola, which is, those are big numbers. So that's what bothers me, not the absolute value of 30. It's just this dollars behind that. Another thing which is talked about a lot is the concentration risk of these large companies in the index. For sure, they're a bigger component. There's roughly 30-something% today of the, or the high 20s, 30% of the index is these companies. This graph here was sent to me by one of my colleagues, and it shows historically, it goes back to 1800. Okay, so forget that. Just look at the red circle on the right. The blue line at the top is the 10 largest companies weighting in the index. You can see on the far right a definite increase in that. But if you look back, we've been here before, so it's not a new phenomenon. We've had concentration risk in the past. For me, it's more important about how much money these companies are making. Today, what gives me a little bit of comfort about the mega caps is they are super profitable. Their profit margin, the median profit margin of the 10 largest companies is something like 28%, which is huge. You can only get a profit margin like that if you are in technology. A traditional company would never have such a high profit margin, be much closer to 10%. So that's concentration risk. Okay, let's talk about NVIDIA, because this is actually quite a fascinating company. I just want to remind you, Pioneer's style of management is top-down asset allocation. We are not stock pickers in our global portfolios. And so we wouldn't be looking for a company like NVIDIA. And I'll show you that it's been trading so expensive. Even if I was a stock picker, I would probably never have bought NVIDIA because it was always trading so expensive. So we've had a 3-fold increase in 1 year and a 25-fold increase in 5 years. That is humongous. That's the type of behavior you expect from penny stocks, not from big companies. It's hit a $3 trillion market cap, and it has a 45 forward estimated price earnings multiple. That means take next year's expected profit, you expect 45 years worth of next year's profit, including the stock price. That's a lot. That's expensive. Okay. That means the market is expecting NVIDIA to continue to grow. And again, just think about the size, the amount of profit that they have to generate to justify that share price. So the rise is unprecedented, not just in percent, but in dollar terms. Just to compare it to another company, Tencent is the Chinese Facebook. Okay. And if you were to put $1,000 in Tencent in December 2022, today it would be 1,100. These two companies were competing for 10th place in the global index in 2022. And now $1,000 invest in NVIDIA in 2022 would be 8,400. So really big growth in this company. again, just to put in context the dollar value of the size of this company. The dot-com bubble of 1999, 2000, the entire bubble was like 3.5 trillion. Okay. So NVIDIA has in the last 18 months put on in its market capitalization growth, it's put on 80% of the dot-com bubble's growth from 99 to 2000. Should we be concerned about that? Maybe. Let's talk about that some more. Okay, next slide. All right, so some people compare NVIDIA to Intel and Cisco. Intel and Cisco in 99, 2000 were the hardware companies of the internet, okay? And if you put them one on top of the other, the graph of Intel and Cisco leading into the dot-com bubble looks pretty similar to NVIDIA's. The dot-com bubble burst, and Intel and Cisco fell and took many years to recover, okay? The proponents, the fans of NVIDIA will tell you today, this time it's different, NVIDIA is different, because their chips are so advanced, they're way ahead of the competition, they've got a software business model that is linked to the chip, and they say it's different. Experience tells us to be a little bit skeptical about these type of things, and it's going to be extremely difficult to call this share price going forward. Okay, I just want to point out again that NVIDIA always traded expensive, and most stock pickers didn't buy it. Interestingly, about stock pickers, I read yesterday in a letter from Orbis, who are a stock picker, they say that 93% of active manager stock pickers have failed to beat the index over the last 3 years. Okay, and those 7% who did beat the index, it's extremely difficult to find them before they beat the index. You can find them after they've beaten the index, but it's very, very difficult to find them before. So that gives me a lot of comfort in the pioneer way of investing, where we bought the S&P 500 and we bought NASDAQ, and our thinking was allocate to the market generally, and you will catch these success stories automatically. And that's exactly what happened with NVIDIA. We got NVIDIA in the S&P 500 index tracker. We've got NVIDIA in the NASDAQ index tracker, and we have benefited from that very strongly. It would be super difficult, and most managers didn't pick NVIDIA. Obviously, everybody's kicking themselves to say, why didn't I buy NVIDIA? Go back 5-10 years, nobody had even heard of NVIDIA, unless you were in the chip space. But so we need to be a little bit realistic about that. Okay, moving on from the equity market to the bond market. For me, the bond market is business as usual. We're collecting our coupons. There's a little bit of rate-based volatility, nothing like the 2022. The current yields are satisfactory. They're not amazing. There's a little pickup over cash deposits. Spreads are tight. What do spreads mean? Spreads mean how much you're going to earn over your risk-free rate, particularly in high yield. So those of you with a portfolio pioneer, you're going to see in July, we're going to be selling our high yield exposure because we feel that we're not getting enough of a reward for that high yield risk because that spread has come down. Okay. And within the bond space, we're favoring a little bit more duration, not huge, because interest rates could go up, but we do favor a little bit more duration. One of the problems now with bonds, okay, is reinvestment risk, and it's even more valid now than it was 2 years ago. What does reinvestment risk mean? Today, if I buy a bond, a good company bond, and it matures in 2026, okay, and I've bought it and I've locked in a yield of, say, 6%, right? Now, everyone expects interest rates to come down, right? That is the base case, and they will come down. They will absolutely come down. Not as fast as everyone initially thought, but they're going to come down. So when that bond matures in 2026, and we want to buy the identical bond again from the same company, we're not going to get 6%, okay? We're going to get some number less, say 5% or 4.5%. And that is reinvestment risk. So what we're doing now is we're looking carefully at our bond portfolios and seeing where can we extend the duration, where can we extend maturities and try and lock in these type of better returns for longer? They're not a huge difference to cash. The most common question I get, and you'll see it later on when we deal with questions, is why shouldn't I just put my money in a fixed deposit? And I would say your main reason is this reinvestment risk going forward. And I'll deal with that in the questions. Okay. Inflation, as I said earlier, 8 down to 3 was the easy part. Round about 2.7, 2.6 right now. The Fed needed to go down to 2%. That's what they want. We expect to stay roughly where we are till the end of the year. Services is the problem. What are services? Services, the cost of services is salaries. Reducing salaries is not so easy to do, especially if it's skilled labor. So trending down, Fed policy is working. Some of the lingos that the slogans you've heard, higher for longer. The latest one, I love the financial services industry sometimes. The latest slogan I'm hearing is later and fewer. So later till the first and second cuts in interest rates, and fewer rate cuts than what we're expected. Again, it's going to take time to bring that inflation under control. This is a graphical presentation of inflation. The yellow is services part of inflation. The purple is core goods. The red is energy. The blue is food. You can see that a lot of these elements of inflation are coming down, right? So this is disinflation, reducing amounts of inflation. We're not in deflation. We're not in reducing prices. It's just the rate of prices increasing is slowing down. That's disinflation. And you can see from this graph how that the services component has barely moved over the last year and a half. So that's the problem. It's the cost of delivering services via salaries, which is going to take a longer time to bring under control. It's very difficult to reduce the someone's salary or reduce your staff whilst you need staff, and the people are complaining about the cost of their groceries. So you can't really reduce your salary bill very easily. Okay, let's talk about the elections in the US, because this is probably the big event. Before we go into the elections, I want to just share a philosophical thought. Do elections matter from an investment point of view? Do they matter at all? Because we often focus and we put a lot of intellectual energy into this issue. And my instinct is to tell you, largely speaking, they don't matter that much, okay? In the short term, yes, they matter. There could be a lot of short-term volatility, not huge volatility. I don't think minus 20 or plus 20 based on the election. There'll be a little bit of volatility based on election uncertainty. But then we get over the election. The US economy, thankfully, is much stronger and much deeper than any one White House official. I get irritated when I watch these politicians take credit for the good and blame the other guy for the bad in the economy when they're both responsible, or the issue is so much more complex. But they love to grab the headlines and say, the other guy did this and the other guy did that, and they're responsible for the bad and I'm responsible for the good. Really childish behavior. And again, it's not with election, it's not about what they promise, because when they're in office, they often don't deliver what they promise. So whatever policy statement they talk about now, once they're in office, we don't know which of those policy promises they're going to deliver on. So it's very hard to predict what the economic and market impact would be. The last point is that the US has a system of shared control, and we have the Congress, which is made up of the Senate and the House, and these is a separation of power. So the result doesn't just depend on who wins the White House, it depends on who wins the Congress as well. So as you know, it doesn't depend on the total number of votes. There's the system of electoral college votes, which is quite hard to understand. Different states have a different impact. And at the end of the day, you have a small number of very critical states that will define the outcome of the election. So whilst we're reading currently that Trump is going to walk it, it's not that obvious, okay? It's not that obvious. And my view is that Biden will not be running in November. I watched that interview last Thursday. I cringed with embarrassment. I felt sorry for the guy. It was terrible. It was absolutely terrible. And I'm surprised how the senior Democrats are backing him and doubling down and denying his condition. I just don't see how he's going to run for the election and for another 4 more years, and given his state right now. So what we expect to happen in August, there's a Democratic convention. Prior to that, sometime prior to that, Biden will announce that he's stepping down, he's not running for president, and they will vote in a new person. And whoever that person is, you will see a boost in the Democrat polls, okay? So right now, if they replace Biden, all bets are off. We're not sure what's going to happen. Okay. Let's just have a look at different aspects of their policies. Tax policy. In 2017, when Trump was in power, he put in these tax cuts, which expire automatically in 2025. If he's in power, he will extend these tax cuts. If Biden or the Democrat, whoever replaces him, wins, we expect to see higher taxes on the wealthy and on corporates, not so much on your average middleman, on your average person. Immigration, Trump is talking big talk about deportation and enforcement, blah, blah, blah. Extremely difficult to undo the immigration disaster over the last few years. Biden talks about strengthening resources, but generally has a weaker stance. I don't understand their approach there, but that's the difference. On trade, Trump talks about a 10% tariff on all imports. A tariff is going to be inflationary. Trump is trying to fight inflation. So I don't know what he's going to do or not do. We expect a lot of noise in that space if he wins. We expect him to try to restrict China. But again, a lot of this is going to be blah, blah and talk, and it's not going to be real. Biden also mixed messages, but generally more of an open policy. Energy is a big deal. Trump wants to reduce the cost of gas at the pump no matter what. He wants to exit the Paris Climate Accords. Biden will continue to implement a cleaner policy. A cleaner, as good as it is for the world, is going to be more expensive. It is inflationary. We need to see what will happen with that. Ukraine, Trump will come in. We think he will force a deal and give Putin a ladder to climb down the tree, maybe. We don't know, but that's the thought. And Biden will continue to support Ukraine, and the Ukraine war will just continue forever and a day because Russia's not backing down anytime soon. NATO, Trump is making demands on other members. He wants to reevaluate NATO. I'm not sure that has a major market impact. Middle East, I think you all know this. Trump more restrictive on Iran and more supportive of Israel, but not unconditional support of Israel. And Biden, definitely the appeasement of Iran, the diplomatic solution to Iran's nuclear ambitions, and push for some sort of ceasefire here. Again, I talked about the Senate and the Congress. Currently, the Senate is 51 Democrat, 49 Republican. Not the whole Senate is up for re-election. Only 34 seats are up for challenge. And the mix of which states this is favor the Republicans. Okay, so the base case is that the Senate will go to the Republican. The House of Representatives is too difficult to call. It's much bigger, many more seats. It's too close to call. Okay, we'll have to see who the Democrat candidate will be. If it's Biden, whatever, still too close to call. Goldman Sachs reckon that there's a 40% chance of a Republican clean sweep. If there's a Republican clean sweep, we think that's good for markets. If there's any sort of division of power, then we expect more dysfunctional behavior, more fighting over debt ceilings, failure to put through important legislation, et cetera, et cetera, et cetera. So we'll see what happens there. This is just a graph of a graphic of showing what happens with a Republican clean sweep and a divided Congress with different people in the White House. As I said, any sort of division of power is going to be that fighting, that dysfunctional management. And if there's a Republican clean sweep, they can pretty much do whatever they like. It may not be good, but I think the market will like the ability of the Republicans to run the country. Okay, let's just summarize that. Trump is clearly in the lead right now, but it's not, when it comes down to the electoral college story, it's not, his lead is not as big as you think. I believe Biden will be replaced by November. And when he is replaced, expect a big jump in the Democratic polls, and it'll be game on, much closer race than you think it is. The smart move for the Democrats in August, in my opinion, would be to hire a more centralist, more balanced, less of a progressive candidate. And if that candidate is, sensible and from the center, he could pull votes from the Trump side. If they bring someone who is more progressive, then I believe they'll lose the election. So if the Democrats want to win, they're going to have to bring someone from the middle, in my view. Again, Republican clean sweep will be more positively received by the market. Just to show you, put some numbers behind what's happened in the last two elections. 2016, year to date, January to November, the S&P was up 7%. Okay, this year we're up to June 15%. So we're already way ahead of that in pre-election market run. Then for the year after, from November 16 to November 17, the S&P was up 23%. Was that Trump policies, or was that the removal of uncertainty around the election? Who knows? But there was a greater run after the election. In 2020, we've got this COVID blanket, which blurs things. But from January to November 2020, the market was up 10%, again, way behind where we are today. And then for the year after, it went up 35%. So part of that 35% is a COVID boost, okay? So but still a very positive post-election. Given where we're at so far in 2024, maybe the market assumed that Trump is going to win, and we got some of that post-election euphoria already now. Maybe it's just a theory, but it's still, I'm reasonably optimistic post the election. Some skeptics, particularly Trump haters, will say that he's going to influence the Federal Reserve. Now, the independence of the Federal Reserve is a philosophical point. It's supposed to be completely independent, but it's never truly independent, okay? But they remain professional. They remain focused on reducing inflation and reducing unemployment. That's their mandate. There might be some political noise, but on a whole, I don't expect any more political influence under Trump than we've had under Biden. In 2 years' time, Powell will resign, and Trump, if he wins, will select the next Fed. That is more significant than your ongoing potential meddling in Fed policy. A very important point, which is not talked about much, and that is if Trump wins, given the state of the fragile state of the US political landscape now, and we see some really dysfunctional behavior from socialists and far left elements, it's hard to believe that Trump's presidency will go unchallenged. And that might be a lot more serious than we think, okay? It's not going to be so smooth. I believe there will be some sort of disruption. There are a lot of people who really think that badly about Trump and will act on that. So it's not going to be plain sailing. They will try to impeach him. Within 6 months of him being elected, they're going to try and impeach him on some basis. So there'll be a lot of dysfunctional behavior. Let's talk about Israel. Okay. Taking a view on the Israeli economy requires taking a view on the war, and that is exceptionally difficult. And that is, with all due respect to everybody, above my pay grade. I can't predict what's going to happen with the war. The Israeli economy is not all bad news. There's a lot of resilience. There's a lot of strength in the financial services sector. insurance companies, banks, etc. So not all bad, but definitely areas of pain. The Bank of Israel reduced interest rates by 0.25%, arguably a little bit too early. Why did they do that? Because the economy is feeling some pain. Why don't they do it more? Because the war is inflationary and they're scared of what will happen to the shekel. They need to protect the shekel, so they can't have interest rates too low. And there's some inflation forces coming from war spending, okay? Bank stocks in Israel are looking pretty attractive. They're trading at a discount to NAV. So we like those. Real estate companies, we like less. They're trading cheap, but for good reason. There's a lot of pain that has to work itself way through the Israeli real estate market or public real estate market. When it comes down to what does the war mean, I think the key statistic is debt to GDP. Going into the war, Israel had a very healthy, low level of debt of GDP, roughly in the high 50s, 60%. We're currently approaching 70%. And the longer this war goes on, the higher that number will be. I think we've got quite a lot of room before things start to look bad. There's other countries with much more debt to GDP than we have here in Israel. But that's the direction. At the end of the day, the country needs more debt, more money to cope with the war. So that's the key number to watch. As that gets weaker, it does put pressure on many things, interest rates and on the shekel. We're expecting tax increases. We expect VAT to go up 1%. Some say 2%. I don't think so, but 1%. And there will be some other taxes coming through here and there. Okay. This table I prepared to show you what the market thinks about Israel's risk. Okay. You've heard of rating agencies. Rating agencies give a rating, AA, BBB, whatever, on both companies and governments. I prefer, when it's particularly governments, I like to look at the price. The price of a bond can be expressed in yield. So let's just look at this table. USA 10-year dollar bond is trading at 4.3. Israel's 10-year dollar bond is trading at 6.1. Okay, that is a spread over US treasuries of 1.8%. Let's go back a year when interest rates, the dollar 10-year was 3.8 before the war. Israel's 10-year in dollars was 4.75. The spread was 0.9. So we've had spread widening from 0.91 to 1.8. That's a lot, okay? That's a lot of spread widening. That's the market saying, Israel, you're no longer the country you were, all right? You need to get over this war, but from a risk point of view, you're significantly risky. How much more risky? I've chosen two countries randomly here that are also dollar bonds. So the Philippines, 5.2. So the market's saying Philippines is a lot less risky than Israel. And Mexico at 606. So the market's saying Israel has roughly the same amount of risk as Mexico. Not a great benchmark. Their spread widening has been minimal. Their spreads have been flat over the last year, but Israel's spread is showing a significant increase in risk. Okay. Whoops, I think I said that. Okay. So just to wrap up before we deal with some questions, how are we doing for time? On condition that there's no significant worsening of the geopolitical landscape, and a lot could happen on that landscape, we expect rate stability of between 4 and 4.6 on the 10-year US. That means that our bond portfolios should be okay. They'll carry on ticking on, collecting their coupons. Okay. We prefer duration risk. We're aware of this reinvestment risk that I explained earlier. The equity market, overall, we've had a great run. I'm not expecting any sort of disaster. Reasonably positive that we'll get some gains still going forward, particularly if it's a Republican clean sweep. The AI theme is still there. These companies are spending insane amount of money on AI, and that is still helping to push the market up. I don't believe we're in AI bubble territory. It'll probably come down the road, but we're not there yet. Okay. Some questions received on registration. When you register for this webinar, you have to fill in an annoying question, forces you to. So here's some of them. I've grouped some of them together because they were similar, but let's see what you guys are thinking. For a safer customer, how much should be placed in higher risk and how to produce a better return? And what is my future prediction on safer assets? And should we be more adventurous? Okay. So the adventurous aspect, that's very personal. It relates to psychology. How would you react if the markets fall out of bed? And that's a very personal question, and you need to discuss that with your relationship manager. I always like to say, what is the risk budget? Is your portfolio going to be -10, -20, -30 before you really get upset and start panicking? Okay, no one likes to lose, but we have to operate with a risk budget. What is my projection on safer funds? Well, the US dollar denominated corporate bonds, say a nicely spread portfolio can produce 6.5% before fees. Maybe a little bit more depending on how risky you go. And how much you put in that safer basket versus the equity basket, which is expected to produce 8, 9, 10%, then that depends on how adventurous you're willing to be. Which countries, regions have the best prospects for wealth gain over the next 5 years? We have a bias towards the USA. It has the deepest economy, the strongest economy. Europe is, we have a joke in our investing committee that Europe is for holidays, not for investing. There are still some companies in Europe, but you've got this overhang. Currently, you've got a big political overhang. You've got the Euro experiment, which could break apart at any time or come under pressure at any time. And you have a lack of innovation that you have in the US. So Europe, we're not huge fans. Japan is a more complicated situation. And then you have the world of emerging markets, which leads to a question further down about India. Emerging markets are much, much riskier and much harder to predict. So that defaults us back to the United States, where that's the place where we expect the most stability of growth. Question about US regional banking exposure to commercial real estate. I don't invest in regional banks. We do hold a financial ETF in our portfolios. Inside that financial ETF are the big companies like Bank of America, JP Morgan, Berkshire Hathaway, etc., AIG. These companies have limited exposure to commercial real estate. I think JP Morgan has 10%, Berkshire Hathaway 15% or something like that. Not huge, and not all commercial property is bad. Okay, some of it's very good. So I don't expect a major problem from commercial property on the big financial organizations. Regional banks, I'm not sure. Certainly, commercial property exposure in regional banking is higher than it is in the bigger banks. What is our investment committee's opinion on India? India is interesting. We have been watching it. We actually had a presentation about India yesterday in the office. The fundamentals of India's growth story, given the size of the population, the size of the economy, the poverty coming into middle class, yes, there's a lot to be said on the positive side. Our reservation comes from the fact that it's EM, and EM cannot be trusted. Cannot be trusted blindly. So if you're going to allocate to India, you want a small percentage because one never knows. We've seen with Brazil, we've seen with China, we've seen with Russia. Stuff happens, okay? Stuff happens, and in the EM world, whether it's a governance issue, a fraud issue, a reporting issue, or political issue, stuff happens. So one has to be very, very careful allocating money to the EM world. If we were going to allocate money to EM, it would be to India. It's an ongoing discussion. We haven't killed that idea, but we're definitely reviewing it. Lots of questions on the currency, on the shekel dollar. my view is that if the war ends, the shekel will strengthen. If the war continues or gets worse, the shekel will weaken. It won't weaken. I don't believe it'll go beyond 4-1 on the dollar. The Bank of Israel will protect it, and so I think that. But again, it's taking a view on the war. So it's a very difficult thing. Currency at the best of times is a difficult thing to do, and I encourage you to think about currency more strategically and less tactically. Okay. The question about the fixed deposit, I mentioned this earlier. Your main issue with a fixed deposit is your reinvestment risk. Now, we were having this discussion with clients a year and a half ago. After interest rates came up in 2022, clients were offered very attractive interest rates. For me, cash is part of an investment strategy. One can never put all your money in cash. What goes into cash is typically your short-term money you might need in the next few years that you can't commit to a long-term market. If you would have chosen a fixed deposit over a balanced portfolio in capital markets, then you would have done worse. Over the last 18 months, a balanced portfolio in capital markets has done significantly better than a fixed deposit. What will be in the next 18 months? I'm not sure. I don't know. But I have a stronger, as the time horizon extends out, I have more and more confidence that we will beat the fixed deposit. So think about it not in terms of which is better and which is worse, but some of your money is short-term orientated, and that should be in fixed deposit. Some of your money is long-term orientated, and that should be in capital markets. Opinion on US debt. So the US debt at 35 trillion is a problem. But the US is still the strongest country in the world, strongest economy in the world. The extent that their government, I don't believe any mix of government, whether it's a split Congress or a Democrat White House or Republican, I don't believe any of them will significantly reduce the level of debt. The question is, can they stop it growing? Okay, I don't believe they'll be able to bring it down. And the thought is actually a dysfunctional mix, i.e. a split Congress, a split Senate and House is more likely to result in less spending and will more likely to bring about a better budget deficit or budget surplus, which will help the debt position. But again, it's as long as America is stronger than the rest of the world, no one cares how much debt the US has, really. There will be arguments about the debt ceiling. And again, if we've got a split Congress, then there'll be dysfunctional behavior. We might have some debt ceiling volatility. Israeli shares, do I have faith in? I mentioned banks earlier and the Tel Aviv 125. Yes, it's part of, not as better or worse. We living in Israel, one needs to be invested in shekels. Our expenses are in shekels. So part of that, part of your money will be in equities and part of it will be in the Tel Aviv Stock Exchange. Within a shekel portfolio, the equity component, for us, we're at the low end of our local exposure. We've actually got more money in our shekel strategies. We've got more money in S&P 500 than we do in Tel Aviv 125. But it's a lot depends on, again, on the war. If the war ends, we expect it to boost, to come up nicely. So you need to think about that. Elections around the world, in Europe, are there places which are less volatile? So again, getting back to my philosophical point I raised earlier, it's not about how much do elections affect markets in the long term, and the reality is they're not huge. Yes, they can affect it in the short term. So don't think about elections as volatility. When you think about market volatility, think about the nature of the asset class. Equities go up and down all the time for all sorts of reasons, okay? And they're going to be volatile. If you can't handle volatility, then you need to be more safer assets and have lower expected returns. Will we be keeping our shekel portfolios or substantially trimming? Not sure I understand this question, but in Pioneer, we think of a shekel strategy, we think of a dollar strategy, and I've already explained that within our shekel strategy, we've allocated more than we normally do in global markets denominated in shekels. What will be the effect of the war in the north on Israeli equities, bonds, funds, etc.? So if something happens up north, risk assets, okay, which is equities and corporate bonds, are going to come down. No doubt about that. On the shekel, we expect the shekel to weaken. Dollar portfolios, the extent that a war with Hezbollah affects global portfolios, this is a harder question to answer. My precedent for that is Ukraine. When Ukraine happened, the markets fell, but then they recovered fully. So I think that political events have a limited effect on the market as a whole over the longer term. This is an interesting question. First question about Warren Buffett. So you'll read, Warren Buffett has an enormous pile of cash right now. The question here is, why does Warren Buffett free up the most cash he ever has? In absolute terms, it's the most cash he ever had. But in relative terms, relative to the size of his company, he's pretty consistent. The amount of cash he has is not a surprise. It's just a huge dollar number. But in percentage of the assets, it's pretty consistent with his long-term numbers. I had to look that up. Okay, has Pioneer taken steps to ensure there's adequate resilience and disaster recovery plans? Oh yes, it sounds like a regulatory question. We absolutely have. We were tested in Corona, and all our staff can work from home. And hopefully we won't need to. And the last question is about navigating risks of 2024, 2005. Again, one needs to think strategically about risk and not be too short-term orientated. Okay, let's have a look at the chat to see if there are more questions coming in. Hold on. Nothing there. But there's something here, Q&A. That's irrelevant. Okay, so unless there are any further questions coming through, I thank you for the time. I hope you enjoyed this chat, and look forward to seeing you under better circumstances. I hope you and your families are all well. Those of you in Israel, those of you abroad, just stay safe, and thank you very much for the time. Wait, a question's come in here. Let's see. Oh, thank you. Oh, thank you to you too. Okay, thank you. Good evening.